In our last currency update of 2016, it's very clear that a number of key trends that have been in place since the US election will continue into the beginnings of 2017. The US dollar has been a big winner, up over 5% versus a basket of commonly traded currencies since the US election. And the Federal Open Market Committee meeting this week arguably added to demand for the US dollar. The rate hike we saw announced was never in serious doubt. However, the so-called dot plots suggest the Fed now expects 3 hikes next year versus 2 in September. The Fed also raised its longer-run median rate projection for the first time since it started producing them in 2012. Now, perhaps market participants, including myself, overanalyze very small movements in Fed projections, but it does feel as if the Fed's outlook for the US economy has changed, and that's something that should continue to support the US dollar into 2017. Another theme that argues the same is European politics. While the Italian government clings to power after Renzi's failed referendum, we face Dutch, French, and German elections next year. That all adds to downside risks to growth in Europe, and that's a factor that continues to weigh on the euro. And the euro last night broke below the March 2015 lows of 104.58 to hit 103.67, a level we haven't seen since January 2003. And economists are beginning to forecast a break of parity to the US dollar early next year. And despite a 39,000 rise in employment here in Australia, suggesting that we may have hit a turning point in the labour market, the Aussie dollar succumbed to a strong US dollar. Having hit a high of 75.25 early this week, the Aussie dollar hit a 3-week low of 73.38 last night. One factor that is leaving global investors nervous is the possibility that Australia may lose its coveted AAA sovereign rating. What feels like a structural deterioration in the budget in a post-GFC world has seen discussion of a downgrade at various points over the last 5 years. In July, risks of a downgrade increased when S&P placed the rating on negative outlook. This chatter around a potential downgrade has grown ever louder as MYEFO, the mid-year budget update, approaches. With this event taking place on Monday, if a downgrade does take place, that'll be seen as another reason by global investors to sell the Australian dollar. To be sure, commodity prices remain strong. Iron ore remains above $80. Coking coal, even after a $50 drop in the last week, are still at $260. And crude prices remain above $50. This should tend to limit downside risks for the Australian dollar. However, a strong US dollar and risks to the AAA rating suggest further weakness over the holiday period. Low 73s and possibly mid 72s appear likely over the holiday period. On that somewhat somber note, I'd like to take this opportunity to thank all our regular viewers and wish them all the best for the holiday period and the new year. And we can pick up these key themes in our first currency update in 2017.